Welcome to the Tricord Advisors podcast, where we answer life's hard questions to help you make smart decisions with your money. I'm Jeremiah Lee, and this is Randy Barkley. We're both certified financial planners. I'm also a California licensed attorney. Welcome back. We are talking about tax planning versus tax preparation. We're going to take a little bit dive. The last section, if you missed it, you can catch it on YouTube. We kind of go through this stuff. But the next section we're going to talk about is a little deeper dive in some of the specifics of things that we plan either year to year or just overall. And one to kind of start with is just a caveat, I guess, with the standard deduction.
Right.
So when people give charitably, they can take a deduction for that. When they have,
they can itemize.
They can itemize, take a deduction. Right. When they have interest on a home loan, they can take that as a deduction. There's a number of deductions that people take each year, but they only take the deductions if they're itemizing. And standard deductions have changed over time, but currently they're fairly high for a married couple, and they're over 20,000. That if there's a number of folks who don't need to itemize, they can just take the standard deduction and move on.
I mean, it varies. I mean, if you have a mortgage going into retirement, and let's say you have $2,000 a month in interest payments, you're in that situation, and then you do charitably, all of a sudden you can exceed the standard deduction married by $27,000 pretty quickly.
Yeah,
you're limited on California. You're given only $10,000 for some of these, property taxes and interest expense. So it really changes. Now, if you're 70 and above, I would say if you're in RMD age in particular, you can use charitable giving, charitable qualified deductions. Again, it's all this interplay, right? I mean, it's taking your age, your circumstances, your charitable. How do you got appreciated assets? We can take all those factors into account.
Yeah,
helping with the preparation or the planning side.
Yeah, the planning side where it meets preparation. One piece that's just as a caveat to say, some people are just taking the standard deduction. The majority of folks that we're working with are giving more. They're having more interest payments. They're making these larger deductions, so they want to itemize. A big piece that we always keep an eye on is the tax law changes. And for 2023. There's not as many changes as there could have been. In prior years, especially the COVID years, there was all sorts of changes. A lot of tax preparers have been scrambling. But for 2023, there's not a lot of changes. But I want to put a caveat for everyone. 2025 is bringing up some potential changes. So the biggest one that I see as an estate planning attorney is the estate gift. So right now, folks don't pay estate tax.
Right now, the gift for 2022. We're talking over in a household, we're talking over $24 million.
$24 million. So
$25 million if you're in 2023.
Yeah. So for this year, 2023, if someone passes away, if their total estate, their houses, their investment accounts, all that stuff is under 25 million roughly. If they're under $25 million, they're not paying estate tax. So I'm really thinking about it. It's an easy thing. If they're above that number, then they're going to start paying estate tax. And estate tax is roughly 40%. So it's a big bite. So for most people, it's fine. And it's been like that for a number of years. However, those very large rates, they sunset in 2025. And before that, it jumped up to 12. Initially, it was down at 5. 5, and if you're a married couple, say 10 million. I'm not sure what it would be in adjusted, but say roughly 10 million. It's still a very large number for a lot of folks. But if you own a few pieces of real estate in California, if you have some good retirement accounts,
business interests,
if you have a business, it's pretty easy to blow right past that number because your estate is it's a big thing. It includes all your stuff, and there's some specific rules of what goes in, what stays out. That's technical, but the general idea that for tax planning for the last number of years, recent years, has been fairly easy for a lot of folks. They just say we're under 25 million, no exotic planning is needed moving forward.
Done.
Whereas if these estate tax rules don't change in 2025, if they aren't extended, I guess I should say, then there's going to be a lot of folks that need to look at their estate again. And that's a planning issue in my mind. It's not a tax prep for the year. Right. It's a planning to say, I know I have these assets. I know I want them to get them to these people, my kids or these charities, whoever they may be. How do we do that? Do we do it now? Do we make it a irrevocable trust and burn your exemptions today? Some people will be doing that. I anticipate if this 2025, it doesn't look like it's going to be extended.
And again, I think the probability that 2025 is going to extend what's on the books right now. I think you'd have to see a change politically, both House and Senate. There would have to be an executive branch that leans towards extending those deductions, those dollar amounts. The chances of that happening by 2025, I wouldn't want to bet my life on it.
Right. Yeah, where we'll be in 2025. It's an interesting question. So the other one that I think is a really big one for planning, we talked about a little in the first part, is real estate. We talked about in the first section that you get a step up in basis at death. But the other thing that I want to bring it back to today is this idea of cost segregation. We've not spoken a lot on the radio about it.
Yeah, and it's a pretty how do you say this is where you're going to need help alongside it.
Yeah.
Because this is not something you just all of a sudden check a box and take it. It's much more involved in
Yeah,
this.
there's a number of reports you need. And so the general idea of cost segregation is if you had purchased a house and done a lot of renovations, you're looking to flip it, say.
Right.
You've done a lot of renovations, you've done a number of things. And then instead of flipping it, you decide, no, I'm going to keep it. This is a great house. It's a great rental.
Right.
Let's keep it for the next foreseeable future. So if you're in that situation, often you would say, well, this is a home. I can depreciate it amongst 29 and a half years. That's how long I'm going to depreciate this property. And that gives you a little bit of depreciation each year. Well, my understanding with cost segregation, the one that we worked on with these, is they'll take all those improvements and they'll segregate them into what is a fixture part of the property that needs to be depreciated over 29 and a half years. And what can be depreciated today? What can be expensed? And what that does for some people, say you've bought a house, you've put a significant amount of money into it to redo it. Well, if you're able to expense, say, $60,000 of those improvements today as lowering your taxes, there's a lot of folks who their minds just kind of explode to say, I can cover other income for $60,000 worth of depreciation.
So let's kind of talk about the significance of that. So
Yeah.
if you do that over 29 years, something that you put on for, let's say, $20,000, you're looking at an annual deduction of what, 1,000?
Yeah,
Maybe
less than 1,000. Yeah,
less than 1,000. Whereas if we can do cost segregation and bring that
Yeah.
forward, you can get almost the full amount.
yeah. Maybe you get $18,000 this year
to
cover it, and that makes that chunk to say, well, I put in $20,000 to fix it, and I get a tax deduction for 18 this year.
Right.
Is significant for many people, and so that's one of those taxing that most folks don't know exists. But if you wanted to do that, it's not like you said, it's not a check the box. Hey, that thing across. You have to do a cost segregation study. Someone has to look at what you paid to it. That costs some money. You have to have a financial a tax preparer that understands this. But the outcome can be significant. So clients that we have that are engaged in real estate, buying real estate, fixing up houses, renting them out.
Right.
It's something we want to make sure that is discussed and even planned for.
Yeah. And so people, obviously, if you have higher income, people that have income of $250,000, $500,000 a year, and they're trying to figure out, how do I shelter some of this income? Now, again, if you basically accelerate the depreciation into a very short period of time, like 1 year or 2 years or whatever, you're not going to get that long-term depreciation over
right.
what you're doing is you're moving everything forward into those few years. But that might be a significant event for you.
Well, and just as a general comment, for someone who has high income now but is planning to retire, if they can shift some of their income forward, like through a 401k, and they can bring back some of their future depreciation through, say, cost segregation, they've taken high periods and low periods and maybe leveled out their lifetime taxes and kept themselves in lower rates. And that it depends, for every person, right? It always depends what the plan is.
It always depends.
But that's the idea of planning, to say, how are we looking at our whole life and being strategic in how and when we take our taxes. And there's other things that are, I'm not saying it's free money, but like a Roth, you put money into a Roth. Well, that growth that occurs from the day you put it in till you take it out is quote unquote free growth. Like there's some benefit.
Yeah. And we've got some clients that are using backdoor Roths.
Yeah.
And I think that's becoming more significant, particularly in this new tax law they just passed, or Secure 2.0.
Yeah.
They left backdoor Roths alone. I thought for sure they would eliminate that, but they didn't. And that's an interesting juncture, I guess.
Right. And they've made the newest piece, I think, is brilliant, which, I think we've talked through clients with this in a while, is at the end of a Roth, at the end of a 529 account. So you save for college for your kids, they don't use it all. Right. And it was your last kid, and you're not sure what to do with it. Well, there's abilities now to roll that into a Roth for your kid. And wow, to set up a Roth for a 23-year-old who just came out of college, they've got $10,000 in a Roth, and then let that grow and be invested until their retirement. What a great benefit that parents are providing.
For sure.
So we'll continue this series of kind of talking through different financial planning topics kind of week by week. Last time we talked about what's the difference between a broker and a investment advisor and a wealth manager. Today we're talking a little bit on taxes, say what's the difference between tax planning and kind of tax preparation.
Correct.
And in future weeks, as we go through, stay tuned. We're going to try and touch on all these items to kind of give a sense of, why you might want a financial advisor, why you might not want one, and
Right.
kind of getting that as a baseline for everyone as they understand this industry.
Yeah. Until next week, folks, may you grow in wisdom and knowledge. Thank you for listening.